The 6 tax questions every retiree must answer before leaving their job. There's a moment that happens to a lot of people in their early 60s. They open a statement, they look at the number, and for the first time, they stop asking, "Do I have enough?" And they start asking, "Wait, why am I still working?" But here's the thing most financial channels will never tell you. That question has a tax answer, not just a savings answer. And if you do not know your tax answer, you might be working an extra 2, 3, even 5 years for almost no additional benefit after the IRS takes its cut. Today, I want to walk you through 6 specific tax questions. 6 questions that the top retirees can answer cold, without hesitating, without looking anything up. If you can say yes to all 6 of them, you're almost certainly ready to retire. And you probably have more freedom than you realize. If you cannot answer even one of them, you are very likely leaving thousands of dollars on the table every single year, and you do not even know what is happening. I will warn you right now. Question 4 is the one that catches almost everyone. I have seen people with $800,000 in savings, people who have been talking to financial advisors for years, who get to question 4 and go completely silent. Stay with me until the end because I'm going to give you the exact number you need and the exact strategy to fix it if you are in the wrong zone. Before I get into the questions, I need to say clearly, I'm not a lawyer. I'm not a CPA, and nothing in this information is legal or tax advice. These are educational examples based on current tax law and publicly available IRS information. Always consult a qualified tax professional for your specific situation. If you're new here, this content is for one specific group of people, retirees and pre-retirees over 60 who want to understand how the IRS actually works. Not the version the news gives you, not the version your neighbor with the strong opinions gives you. The real version explained in plain English with real numbers. Let's get into the questions. Question 1. Do you know exactly how much of your Social Security benefit will be taxed? Most people answer yes to this, and they are wrong. They know that Social Security can be taxed. They have heard that somewhere. But knowing it can be taxed and knowing exactly how much of yours will be taxed are two completely different things. Here's how it works. The IRS does not use your regular income to decide how much of your Social Security gets taxed. They use something called provisional income, sometimes called combined income. Provisional income is your adjusted gross income plus any tax-exempt interest plus half of your Social Security benefits. That is the number the IRS actually uses. Now, if you are a single filer and your provisional income is below $25,000, none of your Social Security is taxed. 0. If it is between $25,000 and $34,000, up to 50% of your benefits become taxable income. If it is above $34,000, up to 85% of your benefits can be taxed. For married couples filing jointly, those thresholds are $32,000 and $44,000. Here's what makes this so damaging. Those thresholds were set in 1983 and 1993. They have never, not once in over 40 years, been adjusted for inflation. Not a single dollar. The tax was designed to hit only the wealthiest 10% of retirees. Today, because of inflation and Social Security cost of living adjustments, it hits roughly 56% of all Social Security recipients. More than half. People who were never supposed to pay this tax are paying it every year. And most of them have no idea why their tax bill keeps creeping up. If you cannot tell me right now what your provisional income will be in your first year of retirement, and whether it puts you in the 0 zone, the 50% zone, or the 85% zone, that is money you are leaving on the table. That is question 1. Question 2. Do you have a plan for your quarterly estimated tax payments in retirement? This one surprises people constantly. When you were working, your employer took care of this automatically. Every 2 weeks, money was withheld and sent to the IRS before you ever saw it. You never had to think about it. The moment you retire, that system stops. And a lot of people find out the hard way that retirement income, Social Security, IRA withdrawals, pension payments, dividends, does not automatically withhold the right amount or anything at all in some cases. IRA withdrawals often default to 10% withholding, even if your actual tax rate is 22%. Social Security will withhold a flat percentage, but only if you ask it to, and even then, it is often not enough. The IRS expects you to pay your taxes throughout the year in 4 installments: April 15th, June 15th, September 15th, January 15th. They call these estimated tax payments. If you miss them or underpay them, you get hit with a penalty. In 2026, that penalty rate is approximately 7% to 8% annually on the underpaid amount, compounded each quarter on each missed payment. The good news: waivers and safe harbor. Now, there is some good news here. The IRS has a waiver specifically for people who are 62 or older, retired in the last 2 years, and had reasonable cause for underpaying. They can waive the penalty entirely, but, and this is the part that costs people real money, they do not apply that waiver automatically. You have to request it yourself by filing Form 2210 with your return and checking the specific box. If you just file normally and pay what you owe, you will pay the penalty and never know the waiver existed. There is also something called the safe harbor rule. If you pay 100% of what you owed in taxes the prior year, or 110% if your prior year income was above $150,000, through a combination of withholding and estimated payments, the IRS cannot penalize you for underpayment, no matter what your actual tax bill turns out to be. That safe harbor is one of the most useful protections in the entire tax code, and most retirees do not know it exists. If you cannot say yes to question 2, meaning you have a clear plan for how you are going to pay the IRS on time throughout the year in retirement, that is a problem you need to fix before you stop working. Question 3. Do you know which of your retirement accounts to withdraw from first, and why? This sounds simple. It is not. Most people think about their retirement accounts as one big pile of money, but the order in which you pull from different accounts has a massive impact on your lifetime tax bill. We are talking about potentially 6 figures of difference over a 25-year retirement. Here's the basic framework. You have 3 types of accounts. Tax-deferred accounts, like traditional IRAs and 401k plans where you pay taxes when you withdraw. Tax-free accounts, like Roth IRAs where qualified withdrawals are completely tax-free. Taxable brokerage accounts or cash savings, where you pay capital gains taxes on growth, but the original contributions are not taxed again. The classic mistake is pulling from tax-deferred accounts too early and too aggressively. Every dollar you pull from a traditional IRA or 401k shows up as ordinary income. That income gets added to your provisional income and can push more of your Social Security into the taxable zone. It can push you into a higher income tax bracket. It can trigger higher Medicare Part B and Part D premiums through something called IRMA-EA surcharges, which we are going to talk about in a minute. And it can limit your ability to do strategic Roth conversions later. On the other hand, pulling from Roth accounts first when you have a lot of traditional account money sitting and growing can be a mistake in a different direction because Roth accounts have no required minimum distributions during your lifetime, so that money can keep compounding tax-free. The SMART strategy. For many people, a SMART strategy involves pulling from taxable accounts first, doing strategic Roth conversions from traditional accounts during low-income gap years, and letting Roth money grow as long as possible. The right withdrawal sequence depends on your specific situation, your tax bracket, your expected Social Security timing, and your RMD projections. But the core point is this: where you pull money from matters at least as much as how much you pull. If you do not have a withdrawal sequence plan, you're making the single most expensive decision in retirement on autopilot. Question 4. Do you know your IRMA threshold and whether you are at risk of crossing it? This is the one that gets almost everybody, even people who have done a lot of retirement planning, even people who have read every personal finance book. IRMA stands for Income-Related Monthly Adjustment Amount. It is a Medicare surcharge, and it works in a way that feels almost designed to trap people who are doing everything else right. Here's how it works. Most people on Medicare pay the standard Part B premium.
In 2026, that is $180 per month. But if your income is above a certain threshold, you pay more, significantly more. And the threshold that triggers the first surcharge is not that high. For single filers, if your modified adjusted gross income was above $106,000 2 years ago, you pay a surcharge on top of the standard premium. For married couples filing jointly, the threshold is $212,000. If you cross that line by even $1, you owe the entire surcharge for that tier, not a prorated amount, the full amount. The 2-year look-back trap. Now, here's the part that blindsides people. The IRS uses your income from 2 years ago to calculate your IRMAA surcharge today. So, if you retire in 2026 and you want to know what Medicare premiums you will pay in 2028, the IRS is going to look at your 2026 income to make that calculation. That means a large Roth conversion you do in 2026, done with the best of intentions, can spike your Medicare premiums 2 years later by hundreds or even thousands of dollars per year. And it works both ways. If you had a high income year, you pay surcharges. If your income drops in retirement, you can appeal to have the surcharge removed using Form SSA 44, but you have to know to do it. The reason question 4 catches almost everyone is that most people are planning for taxes. They're not planning for Medicare premiums as a tax outcome of their financial decisions. But IRMAA is functionally a tax. If a Roth conversion puts your income $10,000 above the IRMAA threshold and you are married, that could mean hundreds of extra dollars in Medicare premiums per year for 2 years. You have to factor that into the conversion math. If you cannot tell me right now what your IRMAA exposure looks like for the next 3 years based on your planned withdrawals and conversions, you have a gap in your retirement plan. That is question 4. Question 5. Have you calculated the real value of delaying Social Security by even 2 years? I'm not going to tell you when to take Social Security. That depends on your health, your spouse, your financial situation, and a dozen other factors that are specific to you. What I am going to tell you is that most people have done this calculation wrong, and the mistake almost always costs them money. Here's what most people know. For every year you delay claiming Social Security past your full retirement age, your benefit grows by approximately 8%. So if your full retirement age benefit would be $2,000 per month, waiting until 70 gives you a benefit of about $2,180 per month. That part people understand. What most people miss: the tax benefit of delaying. Here is what most people miss: the tax benefit of delaying. The years between 62 and 70, especially the years before you start taking Social Security, are potentially the lowest income years of your retirement. You're not collecting Social Security. If you are retired, you're not earning a salary. Your traditional IRA has not started firing off required minimum distributions yet. Those years are an extraordinary tax planning window. During that window, you can do Roth conversions at much lower tax rates. If your provisional income is low, you may be in the 12% bracket for the first time in decades. A Roth conversion done at 12% that avoids a future effective marginal rate of 30% or 40% because of how Social Security taxation stacks on top of regular income can be worth tens of thousands of dollars in lifetime tax savings. The calculation is not just when does Social Security pay more, it is when does the combination of Social Security timing plus Roth conversion timing produce the lowest lifetime tax burden. When you run that full calculation, the answer is almost always to delay Social Security longer than you initially planned and to use those gap years aggressively for conversions. If you have not done that full calculation, not just the break even for Social Security, but the combined lifetime tax optimization, that is question 5. Question 6. Do you know about the $6,000 senior bonus deduction and whether you claimed it? This is the newest one, and it is the one I hear about least often, even from people who are actively working with accountants. Recent tax legislation included a new deduction specifically for taxpayers who are 65 and older. It is $6,000 per qualifying person. If you are married filing jointly and both of you are 65 or older, that is $12,000. This deduction was specifically designed to offset the Social Security taxation problem I described in question 1. If your provisional income is in the 50% or 85% taxation zone, this deduction can pull you out or significantly reduce the taxable portion. The income phase-out starts at $75,000 of modified adjusted gross income for single filers and $150,000 for married filing jointly. Below those limits, you get the full benefit. The critical issue. Here is the critical issue. Not every tax software platform was updated to automatically capture this deduction when it first became available. It is new. It was buried inside legislation. Some preparers have caught up with it, others have not. If you filed your 2025 return without anyone specifically asking you about the senior bonus deduction, there's a real chance it was missed. If it was missed, you can file an amended return within 3 years. A married couple, both over 65 in the 22% bracket who missed this deduction, is looking at $2,840 of refund, not a deduction, an actual refund. If you cannot say yes to question 6, meaning you know this deduction exists, you know whether it applies to you, and you know it was correctly claimed on your return. Go check. Bringing all 6 together. Now, let me bring all 6 together because here is what they have in common. Question 1 is about knowing your Social Security tax zone. Question 2 is about the quarterly payment system that replaces withholding. Question 3 is about which account to draw from first. Question 4 is about IRMAA A and Medicare premiums as a tax outcome. Question 5 is about the real math behind Social Security delay, including the Roth conversion window. Question 6 is about the $6,000 senior bonus deduction that too many people missed. Every single one of these questions is about money that is either leaving your pocket unnecessarily or sitting unclaimed because nobody explained the rules to you. None of them require you to be wealthy. None of them require a complicated investment strategy. They require knowledge. And knowledge in the tax code is worth real money. Where do you stand? The retirees who are in the best shape are not always the ones who saved the most. They are the ones who understood the rules and made smart decisions with the money they had. If you answered yes to all 6, you are genuinely in a strong position. Go back through this information and make sure the numbers check out for your specific situation with a qualified professional. But you are asking the right questions. If you answered no to any of them, do not panic. That is exactly why resources like this exist. Here is what I want you to do right now. Drop a comment below and tell me which question you could not answer. That's it, just the number. Whatever number comes up most often is what will be covered in detail next. If this information helped you, share it with someone who needs to see it. Understanding these 6 questions is the difference between working longer than you need to and retiring with confidence that you are keeping more of what you saved. The retirees who get this right are not lucky. They are informed, and now you are too.